Hi, everyone. As you are filtering in here, I'll go ahead and do some quick introductions. We'll go over a few housekeeping items, and then we will go ahead and get started. So thank you so much for being here today. We love that you attend our webinars. This is a series, our live webinars are free webinars that we do that do offer CPE credit. But let's go over those housekeeping items. So first and foremost, for that CPE credit, you do have to do a couple of things in order to receive that. Um, it looks like we might be missing a couple slides, so I'm going to do this from memory. Forgive me if I'm a little disjointed, but uh, first and foremost, you do have to answer the poll questions as they pop up on your screen. If you have any issues with that at all, please just send me a message. I will help you sort that out. You will also need to fill out the survey at the end of this webinar. It should pop up for you automatically as you're exiting. It will also be emailed to you in a follow-up email. If you have trouble with that, again, please let us know. But you have to do both of those things in order to receive CPE. A couple other things that are important to take note of, and I apologize again for not having this on a slide in front of you. If you have questions as we're going along, please reach out and ask those questions. We are going to do our absolute best to address them at the end of this webinar. If we don't get to them, we will follow up with you via email, but you can use that Q&A button in the middle of your screen to ask those questions. And again, just ask them as you have them. Occasionally, Mike does address them during a poll question, but we will get to them at the end of the webinar. Other things to take note of here. We do offer a series of webinars that are pre-recorded. Those are paid for and they're part of the Salt Vault that we offer. You can just get them one-off as well. But if you are interested in that or need help navigating, please let us know. We also will be sending out today's slides and handouts in the chat box once we get the ball rolling here. They also are uploaded directly to Zoom and emailed to you in 24 hours. So I'm going to do a couple quick introductions, and if I forgot anything, please let me know. And again, so sorry that we are missing a couple slides here. So Sales Tax and More, we are a full service consulting and solutions firm. We have a really great team here of experienced tax professionals who are very dedicated to fulfilling your state tax and related needs. So we do a lot of sales tax returns, sales tax registrations, consultations, research, exemption certificate management, audit defense, and like our name states, more. So if you have questions about our services, please reach out and ask. We would love to work with you. And a quick introduction for Mike as well. See if we have that slide. Mike's state tax knowledge is very well rounded, and he has helped thousands of companies of all sizes and in all industries, and is especially well known for his work in the e-commerce industry. And Mike, if you want to take it from here, hopefully we're not missing anything else, and let me know if I missed anything. But let's get started.
All right, Ellie, thanks very much. Good job without the slides. So thank you. Thank you, everyone, for joining us today. We have a lot of information to cover. We're going to start off with a nexus definition, and we're going to go over some court cases that pertain to nexus. We're going to talk about economic nexus, what some of the current trends are. Then we're going to talk about physical nexus. And even though this is a remote seller, we are seeing more and more remote sellers that actually have physical nexus and just don't realize it. So we're going to touch on that. We're going to talk about marketplace collections. We're going to talk about deregistrations. We're going to briefly touch on income tax. We're going to talk about the future, my view of the future. We're going to talk about how to register and then briefly touch on some registration myths. But before we go any further, Ellie, why don't we get to our first poll question?
Absolutely. That should be up on everyone's screen right now. We just really want to feel for who's in the crowd today. The question is, how would you rate your Nexus knowledge? The options here are what's Nexus, you know the basics, you have an intermediary knowledge, and you are a Nexus, or you are a Nexus expert, or like we like to say, an expert. And no wrong answers here on this one. Mike, it looks like answers are all over the board. Quick reminder that you do have to answer these poll questions in order to receive CPE. And why don't we close this out and move forward?
Okay. Thank you, everyone. And as always, the worst time to find out either you have problems or your clients have problems is when you're being contacted by a state, when you're getting a Nexus questionnaire or a telephone call or an email. And the reason why that's the worst time is because there are programs out there that can help you mitigate some past exposure. Once the state contacts you or your client, those programs are often off the table. Not always. There are a couple of states that still allow, like a voluntary disclosure agreement, like Michigan, after they contact you. But by and large, most of the states, once they contact you, these uh, mitigation type programs are off of the table. So let's start with a brief definition of nexus. And it's really just a fancy word that means link or connection. And when we're talking about taxes, it's the link or connection that must be present before state can require you to do anything, like collect its taxes as a sales tax or a vendor's use tax, or pay its taxes like an income tax, a franchise tax, or a consumer use tax. So link or connection. Now, there are two primary types of nexus for sales and use tax. We have a physical nexus, and that's what the traditional nexus is. Historically, that's what the states looked at. When we're talking about a physical nexus, some are obvious, some are not. Some are common, some are less so. And they're all different types, and every state has their own ideas to what creates a physical nexus or not. Then we have an economic nexus. And an economic nexus is based on thresholds. If you cross a certain threshold, it can be based on revenue. It can be based upon the number of transactions. It can be a combination of both. And each state has different thresholds, what is included in the thresholds. They have different effective dates as to when these thresholds became, you know, were implemented, and then also what the look back period for these thresholds are. So we're going to go over all of that, but these are the two types of primary nexus for sales and use tax. And we say that it all starts with nexus because if you don't have this link or connection with the state cannot require you to do anything. So no nexus equals no problems and no responsibility. And Ellie, we got another quick poll question here.
Yeah, of course. Question two, a little bit of a quiz of what we just talked about. Choose the best definition of nexus for us. So a link or connection with the state that must be present uh, before a state can require you to collect its taxes, working as a state employee and having to pay state income tax, a link or connection with a company and paying them taxes, working as an employee and filling out sales tax returns. And my people are hitting this one right on top of the head with option one, but we'll give everyone a few more a few more seconds here. Their answers are still rolling in. And again, quick reminder, you do have to fill out these poll questions in order to receive your CPE credit. So a couple more seconds, make sure you get that in. Make sure you send me a message right away if you're having any trouble with this, and we can move forward.
Okay. And we're going to be talking about some court cases next. So, Ellie, we ready to move on?
Yes, let's move forward.
All right. So, one of the cases that I want to touch on is National Geographic versus the Board of Equalization. I'm sorry, that's California. And by the way, these are all U.S. Supreme Court cases. This is a 1977 case, and the takeaway from this case is that the taxable activity does not have to relate to the nexus creating activity. And what that simply means is that once an entity has nexus, it has nexus in all of its business channels. And this is becoming more and more important because since the pandemic, a lot of companies have, that were primarily selling to brick and mortar locations. They are now selling over the internet. And what we're seeing is they say, well, I haven't crossed any thresholds yet, so I don't have to worry about collecting taxes. And for their, wholesale business or whatever other type of business they were doing, they didn't have to worry about taxes really. So now they're thinking like in a state like Texas, it's got a $500,000 threshold. They have some time, and unfortunately, that's not the way it works. Their wholesale activity, maybe they've been doing this for 20 years, but that wholesale activity, they may have reps all across the country. That's the nexus creating activity. And now the taxable activity are those sales direct to the consumer over the internet. So once an entity has nexus, it's nexus for all of the different um, business channels of that. They can create nexus for each other. So very, very important. We're seeing a lot of problems with that. Also, I'd like to talk about complete auto transit versus Brady. This is a lot of people out there say, well, the states can't regulate interstate commerce. And, if we go back to the 1930s when we had the first modern day sales taxes, that was true. I mean, even the states didn't think that they could tax interstate commerce directly. But that started to change in the 50s. And then in 1977, we had this complete auto transit case. And the Supreme Court said, yes, you can tax interstate commerce directly so long as it meets this four-pronged test. And it's a fairly easy four-pronged test. Um, one of the items here I want to look at is number 3. Is it discriminatory? So we're going to talk about Illinois. I think that the way they're implementing their economic nexus is discriminatory, but this is a real important case here. Um, is it fairly apportioned? And when we talk about internal consistency, a lot of people get this mixed up. And they say, well, it's double taxation, so therefore it must be unconstitutional. And that's not what this says. It says if every state imposed the same rule and there would be double taxation, then that's unconstitutional. However, most states have different rules, so you can have double taxation. But you know, if every state had the same rules and there was double taxation, then that becomes unconstitutional. All right. So when we're talking about physical nexus, these two cases I think are the most important. In all my years of doing this, um, the biggest nexus issues come based upon the results of these two cases. And the first one is Scripto. It's a 1960s case. Scripto, the Supreme Court said the difference between an employee and an independent contractor is without constitutional significance. And in this case, you had Scripto. They were the pen company. They were located in Georgia. They had 10 independent contractors working in the state of Florida. Florida said, hey, we think this gives you enough of a significant nexus that you should be collecting and paying our taxes. And Scripto said, you're out of your mind. These people, we don't control their actions. They're true arm's length, independent contractors. So how can this create nexus for us? And unfortunately, the Supreme Court weighed in on side of the state. And we have that language there. This issue was revisited in 1987. Tyler Pipe was a Texas company. Washington Department of Revenue went after them. They said, hey, according to the Scripto doctrine, we think that you should be paying our business and occupation tax. And Tyler Pipe said, oh, no, this is not like Scripto at all. We only have one independent contract and they represent multiple people. They don't represent us exclusively. They're really not very good at their job. It's like having someone part-time here with as little as they do. And again, the Supreme Court weighed in on the side of the state, and they said this is very important language here. they said that it doesn't, I'm going to paraphrase the first part. The second part's the really important language. Doesn't matter what you call them, doesn't matter what you pay them, doesn't matter if they represent you exclusively or they represent multiple parties, doesn't matter if they do this on a part-time or a full-time basis. Here's what's important. Are they helping you to establish or maintain a market? And if they're helping you to establish or maintain a market, then that can be nexus creating. And the reason why that language is so important is because the states picked it up and put it directly into their rules, their regulations, their statutes. They use it to provide guidance. The state court systems use it as precedent, when they're deciding cases. So the reason why I think this is so important is because when we're thinking about those activities that create a link or a connection for us, we're usually thinking about ourselves or about our clients. We're not thinking about third parties. So this is, sometimes called attributional nexus, sometimes called agency nexus. I call it third party nexus. I try to keep it as simple as possible. Third parties can create this link or connection. And it's the one that is most often overlooked and has been for years and years. Biggest issues out there. And even with economic nexus, it's still this third party nexus that I think is the biggest issue out there. All right, we're going to touch on that a little bit more when we get to physical nexus. But South Dakota versus Wayfair, this big case, this is probably why many of us are here today. This overturned both Quill and National Bellis Hess. Those were the two cases where the Supreme Court said that a physical presence is required. Now, at this point, what the Supreme Court, they very rarely went back and said, hey, we were wrong. They didn't, when they decided this case, they did not say, hey, times have changed, so we need to change. They said we made a mistake. We never should have introduced the concept of physical presence to begin with. And one of the things they were worried about is if they overturn these cases, it's like they never happened, and they were worried about states going backwards, all the way back to 1967. So South Dakota was smart when they did this. They said we're only going to do this prospectively. We're only going to do this going forward. And what this case did is it ushered in an economic nexus for sales tax. For income tax, we've had it since 1992. We'll touch on that a little bit later. But for sales tax, this is a 2018 case, and this is no longer physical presence required. This new linker connection can be based on sales, can be based on transactions, can be based upon a combination of the two. South Dakota, which was the state involved, they thought $100,000 or 200 transactions was fair. Pretty much all the states jumped on the bandwagon, and even California, but that's changing. We're going to talk about that in a bit here. This economic nexus, non-taxable sales are included in many states. Some states say gross sales. Each state has their own way of looking at it. Two important issues I want to talk about here. Number one, this does not override any other type of nexus. Many people come to me. Here we are, 5 years later, going on almost on 6 years, and some companies are still reaching out. Some of our clients, some of our prospective clients, and they say, Mike, I want to get deregistered in the state of Texas. And I'll ask them, how come? And they say, well, they don't have a transaction threshold, and I'm underneath the $500,000 revenue threshold. So I'll come back and I'll say something along the lines of, well, that's great, but last time we spoke, you had an independent contractor traveling into the state to make sales. Is that still happening? Oh, yeah. Well, unfortunately, at that point, I've got to let them know that a physical presence is almost always, at least when it comes to sales tax, almost always going to trump an economic nexus. So this does not protect you from any other type of nexus. It's just one more way for the states to get you to do what they want you to do, which is collect and or pay their taxes. So real, real important. Second one that I want to talk about here is this is not an internet issue. It's a multi-state issue. And, here we are 5.5 years into this, and our salespeople are still hearing from some very smart people out there, accountants, companies directly. They say, well, we're not subject to the internet tax. Well, number one, this is not an internet tax. Tax and nexus are two entirely separate issues. Um, but it doesn't even have to do with the internet. You don't even need a website and you can be subject to an economic nexus. I mean, maybe you're selling entirely by referrals. Maybe you're selling entirely over the telephone. Maybe you're selling by infomercial or catalog. It doesn't matter how you're selling. If you're selling into multiple states, then this can impact you or your clients. So just want to make those two points there. We're seeing a lot of problems when it comes to issues like that. Now, this is going to be one of the handouts today. It's also up on the free portion of our website. It's a great tool. A lot of the software companies out there, they have, you know, uh, software and or, they just tell you, hey, you're over the thresholds here. And if you're going just off of what these software companies are saying, or just like a platform like Shopify that's telling you over thresholds, I'm seeing companies get registered in way too many states, or not enough states, because they may not know about your other sales. They just know about your sales coming through the Shopify. So this chart is invaluable to protect you or your clients from getting registered in too many places or too little places. And the chart talks about the effective date when the thresholds were implemented. It tells you what the thresholds are, what time period the threshold is based on. There are three primary ways. One is previous calendar year. So that's why January is really, really important. Uh, you look at your sales the previous calendar year, so January through December. And if you're over the thresholds, then in theory, you're supposed to be getting registered and collecting the tax. So previous calendar year, very important. If you're not over the threshold, you don't have to worry about it until next January or end of December. So that's one way the states do it. Next way, previous calendar year or current calendar year. So again, January is a good time to be checking. You look back in the previous calendar year, or you're over the thresholds. If you're not, rather than waiting to January, if your sales are growing very quickly, you got to keep a close eye on this. I'll give you an example. There was this company that came to us, probably 2 years ago. Um, and they were actually a client. They said, hey, we want to check our economic nexus. We want you to tell us if we need to be registered in more states. And they were a relatively small company. They were only registered in 3 states at that time. So I did it was the month of March. So I did it based upon the previous calendar year. I figured their sales in the new year weren't that substantial yet. And they were 2 states that they had to, additional states they had to get registered in. Well, the salesperson came back to me and said, no, Mike, that can't be right. Their sales are virtually exploding. They were on Shark Tank, and this is, an unbelievable growth in sales. I said, okay, well, tell them to send me year-to-date sales, and, we'll look at it that way. And this was the end of March. And through the end of March, their sales had increased so much. I now went back and they had to be registered in over 20 plus states. So it's real important if your business is growing rapidly that you check throughout the year. If it's growing the same rate it was growing last year, a normal growth rate, then yes, maybe you can wait until the following January. But if you've got a rapidly growing business, you need to be checking throughout the year. The last, and this is the smallest amount of states, a state like Illinois, they say a rolling 12-month period, and that you should be checking it every quarter. So that's something that you need to be continuously checking throughout the year. So A chart is great for this. What it is also great for, what's included or what's excluded from the thresholds. Some states are going to say just gross sales, everything's included. Other states are going to say sales for resale are excluded, but all other exempt sales are included. Some states will say all exempt sales are excluded. So, states don't ever make anything easy. Each state has their own ideas. So a chart like this really helps you. And this is where, if you're just selling on a Shopify, they're just telling you, hey, you're over $100,000, but of your taxable sales, maybe you're only, at 30,000. So the software is a great tool in that it's a red flag. It tells you, hey, you need to be looking at this. But before you go out and just get registered, um, you need to have someone look at your specific facts and circumstances. And that's something you can do yourself with the help of a tool like this. What type of tax should remote sellers register for? We're seeing a lot of mistakes get made along these lines. So we tell you which tax. States don't make things easy. They have different types of tax for different scenarios. Is registration required if all the sales are marketplace sales? So if you only have clients selling on Amazon, do you really need to get registered? Most of the time, the answer is no. And then when is sales tax registration required? So some states are reasonable. They're going to say by the beginning of the next quarter. Other states are going to say within 30 days. Some states will say within 60 days. Some states say the very next sale. So if you're in a state that says previous or current calendar year, that's why it's real important, because on the very next sale, after you create Nexus, you could begin to start creating liability. So great tool here. Again, Ellie's going to be handing it out. Now, South Dakota, we mentioned, was going to do this prospectively, and that just means from the effective date. That doesn't mean they're always going to do this prospectively. Prospectively, means going forward. So at that point, no one had any exposure for economic nexus. But those effective dates are getting old. Some states, they're 5.5 years old at this point. And the states are starting to become very, very aggressive. South Carolina, South Dakota, they're questioning registrations. We just had a number of clients receive letters from Arizona saying, hey, you've been registered for a number of years now, and we're looking at your sales. We think that you didn't use the correct date when you registered. So Arizona is now auditing registrants. Illinois, auditing practically everybody going back. We had one client who got registered in January of 2019, and Illinois wanted those 3 months in 2018 where they were not registered, penalty, interest, and all of those good things. And that was before Amazon was collecting tax in Illinois. So they were also going after Amazon sales. So, a lot of clients or prospective clients just want to register on a going forward. I don't want to pay any of the back taxes. I just want to take care of the taxes going forward. Well, that's getting harder and harder to do because you have these states going back and specifically auditing the registration dates. Alabama, Kentucky are sending out notices. They're nice guy notices now. They're just saying, hey, we want to remind you that you have a responsibility to get registered for economic nexus. Utah is becoming more aggressive. They actually purchased a list of of companies that they believe are over their thresholds, and they've been following up on that. You've got other companies like other states like Florida getting the information directly from Amazon. So this is going to be a bigger and bigger issue the longer we go on. So don't procrastinate. The reason why a lot of people are procrastinating based on what they're telling us, number one, they thought that the Supreme Court was going to step in and issue some further guidance, or Congress was going to step in. If we're waiting on Congress, good luck for that. I mean, the last time Congress weighed in on a nexus case, it was an income tax. It was 1959. And at that point, they said, this is a temporary solution. We just want, to put this out here so it'll stop the actions of the Supreme Court right now. But we've got to do surveys. We've got to, do studies. We got to empower our panels, commissions, and, once we have our arms around this, we're going to issue some permanent rules, but right now this is a temporary rule. Well, here we are 60 some odd years later, and we still have this antiquated temporary rule in place. So if you're waiting on Congress to step in, um, maybe your great grandchildren will benefit, but I just don't see them doing anything on this topic. If anything, Nexus is a lot more complicated today than it was back in 1959, and they don't have an interest in it. The other reason is that um, they think that a number of the uh, accountants out there think that there's going to be lawsuits or whatever, or states are going to change. I don't think that any of that's going to happen. I think maybe in isolated states, we may see a challenge, but by and large, I think that economic nexus is here to stay. So the states, there have been two surveys, and one they said 50% of the companies are not compliant, and the next one they said 60% of the companies. The states know that, and they're getting more aggressive. They've given companies a number of years to get used to this idea. The pandemic slowed things down. They were already starting to gear up to come after companies prior to the pandemic, but everything got put on hold. But they're getting more aggressive again. All right, so let's look at a couple of trends. This is the trend away from transactions. And California, when they first rolled out, they were at $100,000 or 200 transactions. They quickly said, that might have been okay for South Dakota, but we're California. We're a lot bigger than South Dakota. We're going to do away with the transactions threshold, and we're just going to have a $500,000 threshold. And these states here, even South Dakota now, they've come out and they've eliminated the transaction threshold. So that first group of states up there, they're the states that had transaction thresholds and no longer have them. The second group of states are states that never implemented a transaction threshold. And then you've got Connecticut and New York, which don't have standalone transactions. In the states that have a transaction threshold, they use the word or. So it's $100,000 or 200 transactions. In Connecticut, it's $100,000 and 200 transactions. In New York, it's $500,000 and 100 transactions. So these are some of the ways the states are looking at transactions. Now, as soon as I say that there's a trend away from transactions, people think that they don't have to worry about it. You do, because while this is a positive trend and it's going in the right direction, there are still 40% or so of the states out there, and some of them are big states like in Illinois and New Jersey, that have transaction thresholds. So until they're all gone, it's something that we need to be looking at still. All right, so here's some things. I call these after the fact because this is after the Wayfair case, years after some of them. And these three states were the last states to actually implement an economic nexus. So now all states, including Alaska, that have a sales tax, Alaska doesn't have one on a statewide basis, but they have one at the local level. So all states that have a sales tax have some sort of economic nexus at this point. Florida, they became effective on 7/1 of 2021. The $100,000, no transactions, and the look back period is the previous calendar year. Kansas, very, very similar, except their look back period is the previous calendar year or the current calendar year. And then Missouri, Theirs became effective on January 1st of last year. And again, $100,000 in no transactions. All right, so here are some other items. We mentioned South Dakota dropped the transaction threshold. They did that in July 1st of last year. Wisconsin dropped their threshold on February of 2021. Arizona dropped the threshold to $100,000. They were originally at they were originally at $200,000. And theirs was a phased dropping of the threshold. They always planned on it. It went from 200 to 150 to 100. Tennessee, on the other hand, they were at $500,000. And when the pandemic happened, they thought their revenues were going to dry up and they needed to figure out a way to get more revenues. So they dropped that threshold from 500,000 to 100,000. And it's been there since that time. That's something to be aware of as these states, start hurting for revenue. Will they perhaps drop their thresholds like Tennessee? Alaska, economic nexus became effective on March 3rd of 2020. And Maine dropped their threshold effective 1/1/2022. And that's their transaction threshold that they dropped. They still have the $100,000 threshold. Pennsylvania, sending notices to those with inventory in Pennsylvania. Pennsylvania has said they're going to continue being aggressive, even though they lost in court. The court ruled against them. We don't expect Pennsylvania to back away from this issue, especially when it comes to income tax. So the issue here was inventory in an Amazon warehouse. Is that enough? Even though Amazon is collecting the taxes, is that enough to create nexus, type of physical nexus, which we'll touch on? Is that enough? And for sales tax, they're no longer really pushing that issue, but for income tax, they are. Illinois, as of 1/1/2021, remote sellers must collect destination-based local jurisdiction tax. And this is a problem. This is the one that's discriminatory, because if you have inventory in Illinois and you're shipping from inside of Illinois, then you're collecting the origin-based tax, the retailer's occupation tax, origin-based. So pretty simple. You just have to worry about one rate and filing a return. Pretty simple. If you're a remote seller and just selling into the state, then you have to worry about almost 4,000 jurisdictions. And we had to hire like 3 extra people just to file Illinois returns because of the extra work. So if you're remote, if you're selling from outside the state, we think that's discriminatory. Now, it's a fairly easy fix. So we're not saying stop doing it. We're saying you should still try to be compliant, but we think that eventually this is going to be challenged in the Supreme Court. We think it's an easy fix, and states sometimes go back retroactively. So, err on the side of caution and try to comply with Illinois. Colorado, self-administered local jurisdictions, and they are very, very aggressive. They now require collection and remittance. Again, that'll probably end up at the Supreme Court level at some point, but for now, who knows how long it's going to get there. And, when you're doing tax planning, it's always better for me to, I think we'd be very conservative in the states that want you to do something, or in this case, the local jurisdictions, it's easier to do it than rather try to fight them. All right, so here's Illinois. This is what we were just talking about here. One thing, if you are a remote seller, and if you're doing your own returns, if someone else is doing the returns for you, well, that's on them. But you got to worry about collecting all the different rates. So if you want to keep things simple for yourself, if you have a physical presence but not shipping from inside of Illinois, it's a third type of registration, and you're getting registered for the retailer's use tax, and that you don't have to collect the local jurisdictions at all. So what you can do is have someone travel, have a salesperson travel into Illinois, and you make your compliance a whole lot easier because now you have a physical presence, but you don't have any shipping from within the state. So it's a whole nother set of rules. Again, this is something that I think is going to cause them problems down the road, but we should try to do our best to comply. All right, so here's something new. Colorado instituted what are called retail delivery fees. And the fee is imposed on any transaction with at least one item of tangible personal property delivered in the state by a motor vehicle. And it's retail only. Wholesale sales don't count. Now, this became effective on July 1st of 2022. It was designed to generate funding for the environmental and infrastructure projects. It originally applied to all sellers and had to be collected from the customer. You could not pay this on behalf of the customer. This created a nightmare because a lot of companies didn't have the ability to have this passed on to the customer. They had to rework their software. So they just said, you know what, we're just going to pay it. So the state finally saw some sense, at least as to who gets to pay for it. They still have it. I don't know if that makes a whole lot of sense. But the revision became effective on July 1st of 2023. Two things. It only applies now to sellers with sales in Colorado of $500,000 or more. And the sellers can now pay on behalf of their customer. They can still pass it on to their customer if they have that ability, or they can pay it on their behalf. This requires a separate registration and a separate return. So it's a pain in the neck. And it's 28 cents per invoice. It's a couple of different taxes that add up to 28 cents. Minnesota, they followed Colorado. We think more states will eventually follow also because this is supposedly for infrastructure projects. And who wants to, our roads are falling apart. Who wants to deny funding for, crummy roads fixture? This one becomes effective on July 1st of 2024. It's got a higher threshold. It's $1 million. And we just clarified it's $1 million of sales in Minnesota. We didn't know if it was $1 million total or $1 million of sales in Minnesota. We just looked at draft language that the state is going to be putting out, and it is actually $1 million in the state of Minnesota. One item of taxable TPP. So again, wholesale doesn't apply. The fee is 50 cents, and sellers can either collect it or not collect it. There's a whole bunch of exemptions for it. So this one's a little bit tougher to implement. But I think we're going to be seeing a lot more of these types of fees. All right. So not every threshold, is economic nexus. So cookie nexus is one type. Click-through or affiliate nexus is another type. And then we have notice and reporting requirements, which is not a tax, but they do have thresholds. And we're going to talk about each one of these. For cookie nexus, the state of Massachusetts is the most aggressive on this. And they look at the installing of data packets on in-state computers to be a type of physical presence, because now there's all sorts of marketing that's going to be done. There's all types of information going to be gathered. So their effective date on this was 10/1 of 2017. And they've actively been enforcing this despite losing multiple occasions in the courts. So this has slowed down a lot because it's getting so old, but every once in a while we see a case like this pop up, and unless you're taking them to court, they put the full court press on you. Where we see cookie nexus becoming an issue is on the income tax side, and we'll talk about that in a little bit. But for sales tax, right now, the only state that is doing this and on a very limited basis is Massachusetts. Click-through or affiliate nexus, this is where referrals are made. through a link or otherwise. It doesn't have to be through a link. It's called click through because that's what the state of New York was going after. They went after Amazon and Overstock.com, where they had programs where you could be a third party and you could have a link on your website and someone would click on that link. It would take you to the Amazon site. And if the sale closed within in a certain number of days, then you get paid some sort of commission or referral fee or whatever else. And New York's reasoning behind this was, well, if one independent contractor in the Tyler Pipe case could create Nexus, how about a whole state full of people sending business? I mean, there really isn't any difference between Tyler Pipe and this click through. I mean, people are sending you referrals and you're paying them some sort of commission for specific performance. And this went to the highest court in New York, and they agreed that yeah, this is actually the same thing as in Tyler Pipe. So it never made it to the Supreme Court. At its height, there were 21 states with this. Since we've gotten economic nexus, a lot of these states have backed off, but there are still some states out there that have active click-through nexus. And this is important because if you're going back and looking at someone's nexus footprint, trying to determine what their first date of exposure is, and you're just looking at the economic nexus thresholds, you may miss this and get surprised when the state brings it up later on. By the way, pay-per-click advertising is not click-through nexus. That's not specific performance. And most of these states have said, it's got to be for specific performance. That specific performance is a closed sale. Advertising is not closed sales. So there was a while, I don't know if they're still doing it, but I looked at a number of Nexus reviews performed by Avalara, and they were saying, oh, you're using Google AdWords, you've got Nexus everywhere. Well, no, that the states actually, in the language of this click-through Nexus, cover that. So it's something that you need to be aware of, but don't let anyone scare you into getting registered when you don't have to be. And a lot of states have now sunset this since we have economic nexus. Use tax notice and reporting requirements. This is perhaps the most heinous thing I've ever seen states do, and the U.S. Supreme Court let them get away with. This started with Colorado. Colorado wanted some of that online revenue, and this was back in 2010. There were no Amazon warehouses in Colorado at that point, so they couldn't make Amazon sellers, get registered and collect tax. So they said, well, you know what? We can't make you get registered to collect tax, but we're going to make your life so miserable and so expensive that you're going to voluntarily agree to collect taxes. You're going to just say, okay, we give up. We're going to collect the taxes on your behalf. And we thought that, Colorado was out of their mind at this point. It turns out they were one of the more sane states, but this spent 7 years in the courts, went all the way to the U.S. Supreme Court. And the first time it was at the U.S. Supreme Court, they said this is not a tax, so the lower court could actually decide on it. And Judge Gorsuch, he wasn't even a Supreme Court justice at that point, allowed Colorado to move forward. It was immediately appealed to the U.S. Supreme Court, who refused to hear it. So what they say is if you're not collecting tax, you've got to provide a series of 3 or 4 notices, depending on the state. Basically, the notices say, hey, Mr. Purchaser, I'm the seller, I'm not collecting the tax, so you have to pay the state tax directly to the state. And you have to turn over a list of clients at the end of the year to the state. Now, at best, the clients think that you're not doing your job and you're making them do extra work. But when they hear that you're turning over, you're turning over a list of with them on it to the state, not very good public relations. So this was not very good. Once you got registered, you didn't have to do this notice and reporting requirements anymore. And some of the, I said, Colorado was one of the saner ones. They had very uh, low penalties. States like Oklahoma, they say there's three things you need to do. And if you don't, there's a penalty of either $20,000 or 20% of your net income into the state over the last 12 months. So, not net income, excuse me, of your taxable sales into the state for the last 12 months. So, the threshold in Oklahoma is $10,000, pretty low threshold. If you had, I don't know, 300 sales or 500 sales or maybe 1,000 sales, it's $2,000 per issue. There's 3 issues per transaction. You quickly get up into the 7 figures. Now, for the first 5 years that this was implemented, the legislature gave Department of Treasury, Department of Revenue, whatever they're calling it nowadays in Oklahoma, the ability to mitigate those penalties. As of last July, that ability expired. So we have not seen any 7-figure penalties yet, but they're potentially there. I think that'll go to court. I don't think that it'll stand up in court, but it costs money to go to court. So most of our clients and most people we talk to, we just say, go ahead, get registered, start collecting the tax, even though you're not over the economic nexus threshold, you're still over this $10,000 threshold. And for our most conservative clients, they usually go ahead and even do a VDA just in case the state tries to pursue them for those non-compliance penalties. Vermont and Puerto Rico don't have any thresholds. Vermont, very low penalties. You don't really have to pay too much attention to that. Puerto Rico, you could have 4 sales there. They could total less than $1,000, and you could potentially owe $25,000 or more. We tell a lot of our clients it's not worth selling into Puerto Rico if you're just making minimal sales. If you are making substantial sales into Puerto Rico, then go ahead and get registered, start collecting the tax. Here is a chart. Again, this will be one of the handouts, and this is the remote seller notice and reporting requirements. You can see that a lot of the states have actually discontinued this since economic nexus began. But say in a state like Washington, they had a $20,000 penalty for each infraction. And it's sunset now, but if you're doing a VDA, there are still periods there that were covered by this. So they make you address this in the VDA. You don't have to pay the tax, but it is addressed. So if they're making you address it inside of VDA, could they potentially go after you, even though it's not effective at this point? It was effective at the time that you weren't either collecting the tax or doing notice and reporting. So just something to be aware of, and this chart's up on our website too. We talked about these trends, number of states, but not all moving away from the transaction threshold. As I said, there's roughly 40% of the states out there that still have these transaction thresholds. Some, but not all the states are eliminating affiliate or click-through nexus, and then the notice and reporting requirements. We think that you need to, especially in Oklahoma, be very, very cognizant of that. Puerto Rico, and to a much lesser degree, Louisiana and Vermont. All right, Ellie, why don't we go to the next polling question?
Absolutely. That question should be up on your screen right now. The question we have here is a true or false question. Quick reminder, you do have to answer these questions in order to receive CPE credit. So the question is, true or false, you must have a physical presence to create Nexus. Mike, most people are saying false. We'll leave this open a few more seconds here. And while they're still rolling in pretty quick, but if you want to review this one, and then we can move forward.
Yes. As of 2018 for sales tax and as of 1992 for income tax, you do not need a physical presence to create nexus. All right. So moving on, let's talk about this third party nexus a little bit more detail. Here's a list, and this is not an all exhaustive list. These are the types of activities that can be deemed to helping to establish or maintain a market. And rather than go through all of these, what we usually tell our clients is if you're sending someone into a state and they're working with your uh, customers or they're working with the general public, then that is generally going to be a nexus creating activity or can be a nexus creating activity. However, if you hire someone to develop some software for you and you're paying them on a 1099 basis, well, that is, they're not helping to establish or maintain a market. So that's not going to be looked at as a nexus creating activity. And by the way, it doesn't matter what you call them. So whether you're calling them independent contractors, if you're calling them subcontractors, subcontractors, that's a big area. A lot of people say, well, I'm not doing it. The subcontractor's doing it. If you are hiring people to install products and you're the one doing the ordering and the hiring, then that's nexus creating. If you're just selling something to your customer and providing a list of people the customer can then go reach out to and set this up themselves, that's not nexus creating. But a lot of times this is on people's websites, and states actually go out and check websites. They comb the web either manually or with software web crawlers looking for things like this. So just be aware of I had one company that said, well, we don't do that, we just want to make it look like we have a bigger footprint than we do. Well, take it off your website, you're making yourself a target. So anyway, this is something you don't even have to put a label on it. You don't have to call them subcontractor, independent contractor. If you're hiring a company to perform services on your behalf, there is a good chance that this is going to be nexus creating. And the reason why this is such a huge problem is that most people, really smart people, just don't think of third parties creating a link or connection with the state on their behalf or on their client's behalf. But this is a huge one. Like I said, in all the years I've been doing this, this is the one that has caused the most angst. All right, so travel. It's not just where your employees or contractors live, but anywhere they travel on your behalf. Inventory creates physical presence in most states. Now, even Amazon inventory creates a physical presence in most states. Now, some states have changed their position since Amazon has started collecting. For example, in the state of Texas, for sales tax, not for the franchise tax, but for the sales tax, if the inventory that's in the Amazon warehouses is only used to fulfill Amazon sales, that's no longer nexus creating. However, if you're using Amazon fulfillment to fulfill your Shopify sales, then that still is nexus creating. In Arizona, if Amazon moves the inventory to Arizona, no longer nexus creating. If you ship directly to a warehouse in Arizona, is creating. So, and for most other reasons, inventory still creates a physical presence. Related entities. I mean, if third parties can create nexus, how much easier is it for a related entity? Especially if those related entities are performing services for one another, or they're not true arm's length companies. I mean, if they're sharing bank accounts or sharing inventory, if they're not all arm's length transactions, then they're creating nexus for each other for sales tax purposes at the very least. Here's a big one: ownership or rental of tangible personal property. If you lease or rent to others, you still have an ownership interest. And now that uh, thing that you own is in another state. Could be inventory, could be equipment, very common nexus creating activity. Here's a big one. Um, with so much done online nowadays, when I talk to people, they say, hey, well, Mike, I don't have a link or connection anywhere. I do all my business in the cloud. Well, unfortunately, it's the states don't look at it that way. Where you live or operate your business from creates a link or connection. And also where you have employees. So remote employees, during the pandemic, a lot of people went and started working remotely, and the state suspended their rules regarding remote employees during the pandemic, but not any longer. All of those are back in place. So if you have remote employees or allowing your employees to work remotely, that can be creating nexus for you. All right, so here's a list of 10 common nexus creating activities, and Ellie's going to be handing this out. It's also up on our website. When we say common, these are the activities that either all states or majority of the states look at the same. And they're going to be taxable, or excuse me, they're going to be nexus creating across the board. And that's in direct contrast to these 12 state specific nexus creating activities. And these activities are going to be widely different on a state by state basis. And again, these are going to be up on our website. Now let's quickly go over some case studies here. This is a number of years old at this point. At this point, I think Amazon had warehouses in maybe 6 or 7 states, and they didn't have one in the state of Missouri where this seller was located. And he was an early adopter. He went out and got registered everywhere Amazon had a warehouse. And one of the ways that states find you is they check with the IRS to see who's receiving 1099s. And Amazon's required to send out a type of 1099 once you cross a certain number of sales. And so Missouri, checks with the IRS. They get a copy of the 1099 and they see that it's from Amazon, and they say, oh, we got an Amazon seller here and he's not registered in his home state. So they contact him. He contacted us at that point, and he was like, what can I do? And there really wasn't a whole lot that he could do, but he asked us to make the argument that he had a virtual office. He had no location in Missouri. So we told him we didn't think it was going to work, but we would be happy to do it. And we made the argument, and Missouri sort of laughed at us and said, yeah, that's not going to fly. He actually, he's physically located here. Now, we were able to help him out. Not everything he was selling was taxable, so we helped him out there, but state had him pretty much dead to rights. So, and we see a lot more people with that type of attitude nowadays. A lot more people are in the cloud today than they were back when this case study happened. All right, here's another one. This was a camera leasing company. They sold high-grade camera equipment, for like movies and commercials. And Massachusetts found them, and they said they had nexus due to owning TPP in the state. They had audited one of their customers, and they saw that there were leasing charges. And this company said, we can't be doing it wrong. Everyone in our industry does it this way. And that's a whole nother topic. Following, sometimes it's the blind following the blind. But Massachusetts said, get us a list of everyone in the industry, and we're going to go after them also. And the reason how we found out about this, we got a call from one of their competitors, and it was after Massachusetts contacted them, and they said, hey, is this true? And unfortunately, yeah. And they had nexus all across the country, and they were not collecting tax anywhere. So, and most states actually look at a lease as a type of purchase. So there's generally going to be sales tax collected on it. So we helped this company out. We helped them with a number of VDAs, a couple of amnesties, and unfortunately, pretty much everything they were doing inside of Massachusetts was going to be taxable. So Massachusetts had them dead to rights, but that's a big issue. And by the way, while we're on this, a lot of people don't realize everyone thinks that Delaware is a state with no sales taxes. And actually, they don't have a sales tax, but they do have a use tax. And if you're leasing tangible personal property into the state of Delaware, and you have Nexus, the lessor is responsible for collecting the tax from the lessee. So uh, this is a big, big issue, and Delaware is a state that trips up many companies that are leasing on a nationwide basis. All right, here's another one, specialized software company. 30 years ago, CPA said Nexus was created by traveling salespeople. So don't let your people travel and you're going to be okay. This was a fraternity brother of the owner of the company. And for 25 years, there were no problems until they were contacted by a state who said, we believe you have Nexus. And their response was, oh, no, we can't have Nexus. Our salespeople never leave the office. And the state said, well, we audited one of your customers and we have invoices showing reimbursement for travel. So yeah, we're sending people here for some reason. And there are charges for installation and a number of other taxable service. So the state wanted and got 7 years of back tax plus penalty and interest. But this company had a heart attack. And I got a call from the president of the company. He was almost in tears. He thought he was going to jail because he realized at that point that he had exposure everywhere. And based upon how much money he owed to the state of Washington, as the state that found him, uh, he thought he was going to owe in excess of $15 million. And I had to talk him down off of the ledge, had to let him know, no, there's a way forward and you're not going to jail. No one's going to jail. If you collect the tax and don't remit it, that's what people go to jail for. But if you've never collected the tax, there may be increased penalties and increased interest, but no one's going to jail over that. So he said, okay, well, maybe it's better if I do go to jail because as soon as my bank finds out I've got all this exposure everywhere, they're going to pull all our credit lines and we're going to be out of business. And let him know that there, again, were ways forward. He asked me if I would get on the phone with his bank, which I did. We explained everything to the bank, and the bank said, "You sure of this?" We said, "Yes." And the bank said, "Okay, we'll loan you the money to go out and take care of all of this," because they had to do VDAs in 40 plus states. And a lot of times, people do VDAs in groups because they can't afford to do them all, not because of fees, but because of all the money that you have to pay. A VDA, we're going to talk about this more, is going to limit the look back period. So you can knock years of back taxes off and also penalty and get lower interest. When all was said and done, this company that thought that they were going to be paying in excess of $15 million paid a little under $1 million plus our fees. I've never seen anyone so happy to pay $1 million. But you got to realize where they're coming from. They really thought they were going to jail and they thought they were going to be bankrupt. And their bank worked with them. Banks are not always going to do that with you. So if you're not in a position to go out and do 40 at one time, then go ahead and tackle the 5 biggest states first. All right, so how do states find you or find your clients? Number one, auditing your customers. If you're selling on a business-to-business basis, businesses get audited. So when an auditor comes out, they're not just looking at your sales to make sure that everything you sell you've taxed correctly and that all of that tax has been remitted to the state. They're also looking at your purchases because if your vendor didn't charge you tax, it doesn't mean it's tax-free. Maybe it's tax-free, but maybe you were supposed to self-assess and remit it to the state directly as a consumer use tax. So it's a great prospecting area. Some states like Texas, they have a lead card that has to be filled out for each company that had an invoice where tax was not collected. So you're on a list. Information sharing, number one, it's shared with other states. States share with other states or with the IRS. We've mentioned the one Amazon seller about that. Amazon tells them there are a number of states. Amazon gave their list of people who have inventory in the state too. Web surfing, state of Washington, notorious for this. State of California, last I saw was doing it manually. State of Washington does it manually and uses software called web crawlers. Leads, former employees. I mean, if you got a disgruntled employee, they know you should have been collecting sales tax, they turn you in, and some states pay bounties. State of Florida pays a 10% bounty on anything they collect. So not only can they get their pound of flesh, they can also get paid for doing it. Your competitors, sometimes like um, we uh, we mentioned earlier in the camera leasing case, but this is becoming a bigger issue because I see a lot of potential clients. They come to us, they say, well, Mike, I want to be compliant, but I'm worried because I sell big ticket items. And if I start charging sales tax, we're going to lose sales. And none of our competitors are. Is there a way that I can turn my competitors in? Can I get them to start collecting tax? And unfortunately, the answer to that question is yes. Most states have someplace on their website or some type of a telephone number that you can call and turn people in for non-compliance. Customers, if you don't charge your customer tax, consumer use tax is a huge issue for businesses. Maybe the business picks up the phone and calls the state and says, hey, do I need to self-assess and remit tax on this? And the state says, well, who's your vendor? Next thing you know, you're on a list. And some states are just going out there and purchasing lead lists. Now, every state has what's called a discovery unit. And the discovery unit's whole job is to go out and find taxpayers that they think should be collecting the state's tax who currently aren't. And they're the ones who follow up on these lists. Now, just because you're on a list doesn't mean anything. Maybe you don't have nexus. Maybe what you're selling isn't taxable. But it may mean something. And a lot of companies say, well, I haven't been contacted yet. Well, states get backed up. They may call you in 2 weeks, they may call you in 2 years, but you're on a list. So this is the way that the states find you. Not the only ways, but these are some of the more common ways that states are going to find you. Ellie, let's go on to the next poll question.
Absolutely. The question we have here is, what about sales tax nexus concerns you the most? So quick reminder, you do have to answer these poll questions in order to receive CPE credit. Your choices are nothing, you have it down, economic nexus, third parties, travel, and other. And Mike, answers are rolling in here pretty quick, so why don't we give everyone a few more seconds? But again, you do have to answer these questions in order to receive CPE. And we'll give it a couple more seconds here and I'll close it out, Mike.
Okay. Marketplace facilitators. These are companies like Amazon, eBay, Etsy, Walmart. They're not platforms like Shopify, at least not yet. Shopify is moving towards becoming a marketplace. You got BigCommerce, WooCommerce, and marketplace facilitators are the ones who are responsible for collecting the tax. This was ushered in with Economic Nexus. So all 46 states plus DC and Puerto Rico have marketplace facilitator collection requirements. Now, if you're only selling on a marketplace, deregistration, we still, even though the marketplaces have been collecting for years, we still have clients and potential clients coming to us every day and saying, hey, can you get me deregistered? I just found out I don't have to be registered. So if you're only selling on a marketplace, most states say you don't need to be registered anymore. Sometimes even if you're selling through multiple channels, some of the states back out marketplace sales, so you may not be over a threshold. So that's another way that you can perhaps deregister. There are some exceptions. You generally don't want to be getting deregistered in your home state. A state like Washington, because of the business and occupation tax, that's not something Amazon's paying on your behalf. You may need to stay registered because of that. And then states like California, where you may need a resale certificate. In California, unless the marketplace is making the sale, um, if you have sales outside the marketplace, in order to issue a resale certificate, you've got to be registered in California to issue that certificate. So, and there are roughly 10 states, 9 states like that. So that could become a reason to stay registered. Now, getting registered, deregistered because of marketplaces is one thing, but we're starting to see a number of companies out there did very, very well during the pandemic. A lot of online companies did. And their sales crossed a lot of thresholds and they had to get registered everywhere. But now, since people are not doing as much online shopping as they were back then, since inflation is higher, people have less money to for discretionary spending. A lot of companies are falling below the thresholds. So that's a reason to get deregistered. Also, some states have eliminated the transaction thresholds. And if you're not keeping up on this, if you're not checking your Nexus footprint every year, you may be registered in a number of states based upon the transaction threshold, and there is no longer a transaction threshold. So you could get deregistered for that. Business mix change, whether that be products. Maybe you were selling a lot of taxable items. Maybe that item is no longer taxable. Maybe there's now an exemption on it. Maybe you changed the mix. Maybe now you're offering more services than taxes. So the business mix there, and it can be channels. Maybe you were doing a whole lot of direct to the consumer. Now you're doing a whole lot of wholesale. So there are lots of reasons that could create an ability to deregister. Now, a lot of these states where you had economic nexus, they have what's called a 12-month trailing nexus. So you can't get deregistered right away. You generally have to wait 12 months. So that's, again, you still got to worry about your home states, states like Washington, states like California. Here's some deregistration warnings. It's a process that varies between the states. You can't stop filing. We see a lot of companies just say, well, I'm below the thresholds. I don't have to collect anymore. You have a responsibility to collect and remit as long as you're registered. So it's a formal process. Each state is a little bit different. You got to go to the state and deregister before you can stop filing. Otherwise, you're going to get lots of nasty letters and estimated assessments. Just follow the process. And by the way, states are notorious for not doing what they say they're going to do. So we tell a state what we're going to do, we do what we're supposed to do, and then we follow up 20 to 30 days later to make sure it's actually turned off. Another thing, we see a lot of states going out and getting deregistered. I mean, a lot of companies going out and getting deregistered and leaving their tax turned on. Now you've got tax collected and it's not being remitted. That's the cardinal sin of sales tax. So after you get deregistered, you got to turn off your tax. And by the way, income tax, totally separate from sales tax, has its own nexus rules. Deregistering for sales tax generally has no impact on your income tax requirements. So one thing here, and this is not on the slide, but it has to do with turning tax on and off. A lot of times, Shopify will say, well, you have a responsibility to collect tax in this state. So people turn the tax on. They're not tax people, reviewing this stuff all the time. They don't realize you need to go out and get registered. So that's a big, big problem. We're seeing a lot more tax collected, not remitted at this point. All right, so marketplace collection, not all positive. Nexus is still created in most states. You still need to collect tax for your other channels. States are still pursuing sellers for back tax plus penalty and interest. In some states, you'll still have filing responsibilities like the Washington Business and Occupation. And here's the biggest thing. States can easily access seller information, and income tax is going to be the next big battle. Which, here we are, income tax will be the next big battle. FBA sellers are going to be the first target. California's already followed the first shot for the last couple of years. They've been aggressively pursuing Amazon sellers. Pennsylvania followed up. It's not going to stop with FBA, though. Pretty much all e-commerce companies are going to be targets. Massachusetts says Public Law 86272 is unconstitutional in light of Wayfair. The MTC, which puts out a list of protected and unprotected activities as it relates to Public Law 86272. And they now say cookies, emails, or chats exceed the protections. They have virtually eviscerated the protections. You have Oregon created a new gross receipts tax, and gross receipts tax is not protected by Public Law 86272. By the way, Public Law 86272, that's that 1959 law that Congress passed. And it says that if your only activity in a state is the solicitation of tangible personal property, then, and if the orders are fulfilled from a point outside the state and approved from a point outside the state, then the state cannot impose a net income tax on you. So that has protected a lot of companies over the years. It's protects a lot less companies today than it did back then. And it's under full assault at this time. So these are the revised unprotected activities put out by the MTC. We've had 2 states adopt them already, California and New Jersey. And 22 states have said they're going to accept them either in all, in part or in full. I'm not going to go through all of these. You can read these at your leisure, but basically if you're offering any type of customer service on a post-sale basis, those are 2 of the big things that eviscerated. Minnesota and New York have floated proposed guidelines. I think New York is going to come out with theirs pretty shortly. Hawaii, by the way, no longer recognizes the protections for companies with Nexus. Others are going to follow suit. So New Jersey and Hawaii, by the way, their nexus for sales tax is the same as their nexus for income tax. It's $100,000 or 200 transactions, pretty low thresholds. So this is something that, you know, if your sales into those states are material, you might want to take a look at. These are the most aggressive states out there: California, Pennsylvania. Florida, if you're a C Corp, if you're a pass-through entity, not so much. They don't have any personal taxes. Illinois, Puerto Rico, Nebraska, South Carolina, Texas, and Kentucky. This is not an exhaustive list, but these are some of the most aggressive states. Why Nexus matters more than ever? Well, states were already gearing up to track down sellers for economic nexus. It's going to start getting ugly. We've seen 4 states starting to take no prisoners attitude. We think more states are going to jump on the bandwagon. And while they're looking for economics specifically, they're going to stumble across all types of nexus. For example, third-party nexus. So it's bad enough if they find you for economic nexus, but if they come across, you know, third party, maybe you had third-party nexus for 10 years and you've had economic nexus for 3 years. So, and the biggest reason is, you know, are we going into recession? Are we not going into recession? I don't know. But states are already missing out on revenue, and they need to make that revenue up. And historically, during recession, states have increased their discovery efforts, and the discovery efforts are when the states are looking for new taxpayers. So we've got a perfect storm here. We've got states needing more revenue at the same time when they were already gearing up because people just aren't getting registered like they're supposed to. All right, so what should sellers do? Sellers should register whenever there's nexus. What they sell is taxable and the exposure is material. And a marketplace is not collecting the tax. Deregister if all you're doing is selling on marketplaces, if you're not, or if you're not over thresholds. Materiality, by the way, that's my comment, not the states. Most states believe you should be registering from dollar number 1. So the ways to register, You can register prospectively. That means just on a going forward basis. A lot of companies decide to do that. You can't do that in a state like Illinois, Wisconsin, Arizona, or Maine. You've got to use the actual date because those states are going to audit you. You can register through a voluntary disclosure agreement, and then you can register and do managed audit. And Ellie, let's do the final poll question.
Absolutely. That should be up on everyone's screen right now. Another true and false question for you. Registering historically is one of the ways you can register. True or false? Let's let these answers roll in here. Quick reminder, you do have to answer these poll questions in order to receive CPE credit. And when we wrap up here and you exit, there will be a survey that you have to fill out as well for that CPE credit, but make sure you get your answers in. We're going to review this really quickly here, and then we can finish up. All right, Mike, take it over.
Yes, that is a true statement. All
Okay.
right. So let's talk about voluntary disclosure agreements real quick. And this is a program the states have. As a reward for stepping forward voluntarily, states will limit the look back periods to 3 to 4 years, waive the penalty, and in a handful of states, waive the interest. Without a VDA, if the state finds you, they could look back to the date you first started doing business in the state. In reality, they routinely go back 7, 8, or 10 years. Those are the three most popular look back periods. California goes back 8 years. So if they find you, you could pay 8 years plus back tax, penalty, and interest. If you do a VDA in California, they limit that look back period to 36 months. So you're saving 5 years of back tax, penalty, and interest. And then for that 36-month period, they're waiving the penalty. So you only have to pay the interest. So it's a great tool. But like all tools, it's not a one size fits all tool. I mean, Avalara is out there and they're telling people if you owe more than $500, you need to do a voluntary disclosure agreement. Oh, by the way, we charge $3,500 to do a voluntary disclosure. Why in the world would you pay anyone $3,500 to remit $500? So a basic rule of thumb, no matter who you're going with, whether you're going with us, and we have a program that it's a VDA cost benefit analysis, if that's something you're interested in. But you need to be saving at least as much money as the person is doing the VDA for you. If not, why bother doing the VDA? Just go out and do a historical registration or something along those lines. You can still get penalty waived sometimes. So anyway, that's what I have to say about VDAs. And I want to talk about the future right now. I think we see a dichotomy. The future looks very bright for marketplace sellers. Um, the past is still going to create some issues in some states, but for people who are selling on a marketplace and elsewhere, if they are not compliant, it's going to start getting pretty ugly. States are going to be looking for economic nexus. They're going to stumble across all types of nexus, and the states are going to start making examples of companies. When a state makes an example of a company, they put fear out there, and fear makes more companies step forward so they don't have to work as hard finding you. And then income tax or similar taxes are going to become a much bigger issue. So Ellie, at this point, why don't we turn it over to questions? Do you have any questions?
Yeah, of course, Mike. We don't have any questions at this time. Is there anything else you'd like to cover in these last couple minutes?
Yeah, let's talk about some common myths. One of the reasons that people say, "Oh, I don't want to get registered. I don't have to worry about income tax." Well, registering for sales tax does not create income tax nexus. That is a myth. The nexus for sales tax is different than nexus for income tax. And I don't know of any state that says that if you're registered for one type of tax, you automatically have nexus for the other type of tax. Now, some of the same activities create nexus for both. So you could have nexus for both because of the same activities, but the mere fact of registering for sales tax does not. Sales tax registrations require Secretary of State registration. In some instances, maybe, but in most instances, especially if you're registering because of economic nexus, that is not required. That is a myth. Now, the websites may look at that, make it look that way when you're going to register. They pretty much want you to be registered with the Secretary of State, but it's not required. There's a workaround in pretty much every state. Wayfair creates income tax requirements everywhere. Well, it doesn't. There are thresholds still. And I think this is going to be a huge battle. Lots of things changing over the next year, but there are some states that still follow the old protections. So you will not have Nexus everywhere. And then I need to register everywhere I have Nexus. That's a myth. Maybe you talk about materiality. Maybe you're selling $1,000 of taxable items and you should be collecting $80 worth of tax. Well, you know what? You can't get registered and you can't file returns for anywhere close to $80 in most states. So I think it needs to make common sense. I mean, it needs to be material exposure. I'm a big believer if your exposure is material, you need to take care of it. You need to prevent the liabilities from building up. But I'm not a big believer in going out and doing what a state says just because the state says to do it. It's got to make good business sense. All right. So, Ellie, I think our time is up. And I appreciate everyone having joined us today. And if any questions come up that we didn't cover, just shoot them out to us and we'll see about getting them answered for you. Thanks, everyone. Have a great day.